Jai Hind everyone. Welcome to my YouTube channel which is Explore Yourselves, Banking and General Knowledge, etc. Please subscribe to the channel and also please do like and share and leave your suggestions in the comment section. Today I am going to talk about the housing finance. Housing finance source RBI website. Bank of India is offering this facility. Purpose: consolidate framework of rules, regulations, and clarification on housing finance issued to banks by Reserve Bank of India from time to time. Classification: a statutory directive issued by the Reserve Bank in exercise of the powers conferred by Sections 21 and 35A of the Banking Regulation Act 1949. Previous guidelines. This master circular consolidates and updates all the instructions contained in circulars and clarifications issued. Scope of application: applicable to all scheduled commercial banks excluding regional rural banks. Housing finance. Introduction. Banks with their vast branch network throughout the length and breadth of the country occupy a very strategic position in the financial system and have an important role to play in providing credit to the housing sector. While formulating their policies, banks have to take into account the following RBI guidelines and ensure that bank credit is used for production, construction activities and not for activities connected with speculation in real estate. Various regulations. Acquisition of land. Bank finance can be granted only for purchase of a plot, provided a declaration is obtained from the borrower that he intends to construct a house on the said plot with the help of bank finance or otherwise within such period as may be laid down by the banks themselves. Various regulations. Construction of building or ready-built house. Banks may grant loans to individuals for purchase or construction of dwelling unit per family and loans for repairs to the damaged dwelling units of families. Banks may extend finance to a person who already owns a house in town or village where he resides for buying or constructing a second house in the same or the other town or village for the purpose of self-occupation. Banks may extend finance for purchase of a house by a borrower who proposes to let it out on rental basis on account of his posting outside the headquarters or because he has been provided accommodation by his employer. Banks may extend finance to a person who proposes to buy an old house where he is presently residing as a tenant. Banks may finance for construction meant for improving the conditions in slum areas for which credit may be extended directly to the slum dwellers on the guarantee of the government or indirectly to them through the state governments. Banks may provide credit for slum improvement schemes to be implemented by slum clearance boards and other public agencies. Banks are advised to also adhere to the following conditions in the light of the observations of Delhi High Court on unauthorized construction. In cases where the applicant owns a plot and land and approaches the banks or FIs for a credit facility to construct a house, a copy of the sanctioned plan by competent authority in the name of a person applying for such credit facility must be obtained by the banks or financial institutions before sanctioning the home loan. An affidavit cum undertaking must be obtained from the person applying for such credit facility that he shall not violate the sanctioned plan. Construction shall be strictly as per the sanctioned plan, and it shall be the sole responsibility of the executants to obtain completion certificate within 3 months of completion of construction. Failing which, the bank shall have the power and the authority to recall the entire loan with interest, costs, and other usual bank charges. An architect appointed by the bank must also certify at various stages of construction of building that the construction of the building is strictly as per sanctioned plan, and shall also certify at a particular point of time that the completion certificate of the building issued by the competent authority has been obtained. In cases where the applicant approaches the bank or financial institutions for a credit facility to purchase a built-up house or flat, it should be mandatory for him to declare by way of an affidavit cum undertaking that the built-up property has been constructed as per the sanction plan and or the building bylaws, and as far as possible as a completion certificate also. An architect appointed by the bank must also certify before disbursement of the loan that the built-up property is strictly as per sanction plan and or building bylaws. No loan should be given in respect of those properties which fall in the category of unauthorized colonies unless and until they have been regularized and development and other charges paid. No loan should also be given in respect of properties meant for residential use but which the applicant intends to use for commercial purposes and declares so while applying for loan. Supplementary finance. Banks may consider requests for additional finance within the overall ceiling for carrying out alterations or additions or repairs to the house or flat already financed by them. In the case of individuals who might have raised funds for construction or acquisition of accommodation from where other sources and need supplementary finance, banks may extend such finance after obtaining pari passu or second mortgage charge over the property mortgaged in favor of other lenders and or against such other security as they may deem appropriate. Banks may consider for grant of finance to the bodies constituted for undertaking repairs to houses and owners of building or house or flat, whether occupied by themselves or by tenants, to meet the need-based requirements for the repairs or additions after satisfying themselves. Regarding the estimated cost for which requisite certificate should be obtained from an engineer or architect wherever necessary, and obtaining such security as deemed appropriate. Bank finance should, however, not be granted for the following. Banks should not grant finance for construction of buildings meant purely for government or semi-government offices, including municipal and panchayat offices. However, banks may grant loans for activities which will be refinanced by institutions like NABARD. Projects undertaken by public sector entities which are not corporate bodies, that is, public sector undertakings which are not registered under Companies Act or which are not corporations established under the relevant statutes, may not be financed by banks. Even in respect of projects undertaken by corporate bodies as defined above, banks should satisfy themselves that the project is run on commercial lines and that bank finance is not in lieu of or to substitute budgetary resources envisaged for the project. The loan could, however, supplement budgetary resources if such supplementing was contemplated in the project design. Thus, in the case of a housing project where the project is run on commercial lines and the government is interested in promoting the project, either for the benefit of the weaker sections of the society or otherwise, and a part of the project cost is made by the government through subsidies made available and/or contributions to the capital of the institutions taking up the project. The bank finance should be restricted to an amount arrived at after reducing from the total project cost the amount of subsidy or capital contribution receivable from the government and any other resources proposed to be made available by the government. Banks had in the past sanctioned term loans to corporations set up by government like State Police Housing Corporation for construction of residential quarters for allotment to employees where the loans were envisaged to be repaid out by budgetary allocations. As these projects cannot be considered to be run on commercial lines, it would not be in order for banks to grant loans to such projects. Various regulations. Lending to housing intermediary agencies. Financing and land acquisition. In view of the need to increase the availability of land and house sites for increasing the housing stock in the country, banks may extend finance to public agencies and not private builders for acquisition and development of land, provided it is a part of the complete project, including development of infrastructure such as water systems, drainage, roads, provision of electricity, etc. Such credit may be extended by way of term loans. The project should be completed as early as possible and in any case within 3 years so as to ensure quick recycling of bank funds for optimum results. If the project offers construction of houses, credit extended therefore in respect of individual beneficiaries should be on the same terms and conditions as stipulated for financing the beneficiary directly. Banks should have a board-approved policy in place for valuation of properties, including collaterals accepted for their exposures, and that valuation should be done by professionally qualified independent valuers. As regards the valuation of land for the purpose of financing of land acquisition, as also land secured as collateral, banks may be guided as under. Banks may extend finance to public agencies and not to private builders for acquisition and development of land, provided it is a part of the complete project, including development of infrastructure such as water systems, drainage, roads, provision of electricity, etc. In such limited cases where land acquisition can be financed, the finance is to be limited to the acquisition price, current price, plus development cost. The valuation of such land as prime security should be limited to the current market price. Wherever land is accepted as collateral, valuation of such land should be at the current market price only. Lending to housing finance institutions. Banks may grant term loans to housing finance institutions, taking into account long-term debt equity ratio, track record, recovery performance, and other relevant factors, including the provisions of Master Circular Bank Finance to Non-Banking Financial Companies (NBFCs) dated April 3, 2023, as amended from time to time. Lending to housing boards and other agencies. Banks may extend term loans to state-level housing boards and other public agencies. However, in order to develop a healthy housing finance system, while doing so, the banks must not only keep in view the past performance of these agencies in the matter of recovery from the beneficiaries, but they should also stipulate that the boards will ensure prompt and regular recovery of loan installments from the beneficiaries. Term loans to private builders. In view of the important role played by professional builders as providers of construction services in the housing field, especially where land is acquired and developed by state housing boards and other public agencies, commercial banks may extend credit to private builders on commercial terms by way of loans linked to each specific project. Banks, however, are not permitted to extend fund-based or non-fund-based facilities to private builders for acquisition of land even as part of a housing project. The period of credit for loans extended by banks to private builders may be decided by banks themselves based on their commercial judgment, subject to usual safeguards, and after obtaining such security as banks may deem appropriate. Care should also be taken to see that prices charged from the ultimate beneficiaries do not include any speculative element. That is, prices should be based only on the documented price of land and the actual cost of construction and a reasonable profit margin. Terms and conditions for lending to housing intermediary agencies. In order to enhance the flow of resources to housing sector, term loans may be granted by banks to housing intermediary agencies against the direct loans sanctioned proposed to be sanctioned by the latter, irrespective of the per borrower size of the loan extended by these agencies. Banks can grant term loans to housing intermediary agencies against the direct loans sanctioned or proposed to be sanctioned by them to non-resident Indians also. However, banks should ensure that housing finance intermediary agencies being financed by them are authorized by Reserve Bank of India to grant housing loans to NRIs, as all housing finance intermediaries are not authorized by RBI to provide housing finance to NRIs. Adherence to guidelines on commercial real estate CRE exposure. Lending to housing intermediary agencies will be subject to the circular DBOD BC number 42 by 08.12.015 oblique 002009 or 10 dated September 9, 2009 on guidelines on classification of exposures as commercial real estate CRE exposure and the circular DBOD BP.bc.no 104 oblique 08.12.015 oblique 2012-13 dated June 21, 2013 on housing sector. New subsector CRE, residential housing within CRE, and rationalization of provisioning, risk weight, and LTV ratios. Housing finance, quantum of loan. While deciding the quantum of loan to be granted as housing finance, banks should abide by the following loan to value, LTV, and risk weights. Category of loan, individual housing loans up to 30 lakh, LTV ratios less than or equal to 80, risk weights to 35%. Individual housing loans up to 30 lakh, LTV ratio is greater than 80% and less than or equal to 90%. Risk weight is 50%. Individual housing loans above rupees 30 lakh and up to rupees 75 lakh, LTV ratio should be less than or equal to 80. This risk weight is 35%. Individual housing loans above rupees 75 lakh, LTV ratio is less than or equal to 75%. Risk weight is 50%. Individual housing loans category of loan is CRE RH. LTV ratio is not applicable. Risk weight is 75%. As a counter cyclical measure for individual housing loans sanctioned on or after October 16, 2020 and up to March 31st, 2023, the risk weights shall be as per the circular DOR number BP.bc.24/08.12.015 2020-21 dated October 16, 2020 on individual housing loans, rationalization of risk weights. The risk weights are as under. LTV ratio is less than or equal to 80% and risk weight is 35%. LTV ratio is more than 80 and less than and equal to 90%. Risk weight is 50%. In order to have uniformity in the practices adopted for deciding the value of the house property while sanctioning housing loans, banks should not include stamp duty registration, and other documentation charges in the cost of housing property they finance so that the effectiveness of LTV norms is not diluted. However, in cases where the cost of the house or dwelling units does not exceed rupees 10 lakhs, banks may add stamp duty, registration, and other documentation charges to the cost of the house or dwelling unit for the purpose of calculating LTV ratio. Housing finance. Innovative housing loan products, upfront disbursal of housing loans. It has been observed that some banks have introduced certain innovative housing loan schemes in association with developers or builders. The upfront disbursal of sanctioned individual housing loans to the builders without linking the disbursals to various stages of construction of housing project. Interest or EMI on the housing loan availed of by the individual borrower being serviced by the builders during the construction period or a specified period, etc. This might include signing of triparty agreement between the bank, the builder, and the buyer of the housing unit. These loans products are popularly known by various names like 80%, 80 to 20, 75-25 schemes. Such housing loan products are likely to expose the banks as well as their home loan borrowers to additional risks. In case of dispute between individual borrowers and developers or builders, default or delayed payment of interest or EMI by the developer or builder during the agreed period on behalf of the borrower, non-completion of the project on time, etc. Further, any delayed payments by developers or builders on behalf of individual borrowers to banks may lead to lower credit rating or scoring of such borrowers by credit information companies (CICs) as information about servicing of loans gets passed on to the CICs on a regular basis. In cases where bank loans are also disbursed upfront on behalf of their individual borrowers in a lump sum to builders or developers without any linkage to stages of constructions, banks run a disproportionately higher exposures with concomitant risks of diversion of funds. Disbursal of housing loans sanctioned to individuals should be closely linked to the stages of construction of the housing project or houses, and upfront disbursal should not be made in cases of incomplete, under construction, or greenfield housing projects. However, in cases of projects sponsored by government or statutory authorities, banks may disburse the loans as per the payment stages prescribed by such authorities, even where payments sought from house buyers are not linked to the stages of constructions, provided such authorities have no past history of non-completion of projects. It is emphasized that banks, while introducing any kind of product, should take into account the customer suitability and appropriateness issues, and also ensure that the borrowers or customers are made fully aware of the risks and liabilities under such products. Housing finance, rate of interest. Banks should charge interest on housing finance granted by them in accordance with the provisions contained in the Master Direction, Reserve Bank of India, Interest Rate on Advances, Directions 2016, as amended from time to time. Banks shall ensure adherence to the instructions issued by Circular DOR.MCS.REC.32/01.01.003 2023-24 dated August 18, 2023 on reset of floating interest rate on equated monthly installments EMI based personal loans. Housing finance approvals from statutory or regulatory authorities. While appraising loan proposals involving real estate, banks should ensure that the borrowers should have obtained prior permission from government or local governments or other statutory authorities for the project wherever required. In order that the loan approval process is not hampered on account of this, while the proposals could be sanctioned in normal course, the disbursement should be made only after the borrower has obtained requisite clearance from the government authorities. Housing finance disclosure requirements. In view of the observations of Honorable High Court of Judicature at Bombay, while granting finance to specific housing or development projects, banks are advised to stipulate as a part of the terms and conditions that the builder or developer or company would disclose in the pamphlets or brochures, etc., the names of the banks to which the property is mortgaged. The builder or developer or company would append the information relating to mortgage while publishing advertisement of a particular scheme in newspapers or magazines, etc. The builder or developer or company would indicate in their pamphlets or brochures that they would provide no objection certificate, NOC, or permission of the mortgage bank for sale of flats or property if required. Banks are advised to ensure compliance of the above terms and conditions, and funds should not be released unless the builder or developer or company fulfills the above requirements. The above mentioned provisions will be mutatis applicable to commercial real estate also. Housing finance, exposure to real estate. Banks are well advised to frame comprehensive prudential norms relating to the ceiling on the total amount of real estate loans, single or group exposure limit for such loans, margins, security, repayment schedule, and availability of supplementary finance, and the policy should be approved by the bank's board. While framing the bank's policy, the guidelines issued by the Reserve Bank should be taken into account. Housing finance, housing loans under priority sector. The grant of housing loan for the purpose of the private sector lending targets, including reporting requirements, will additionally be subject to the instructions on private sector lending as amended from time to time. Housing finance, financing of affordable housing, issue of long-term bonds by banks. Banks can issue long-term bonds with a minimum maturity of 7 years to raise resources for lending to affordable housing subject to the conditions mentioned in circular dbr.bp.bc number 25 oblique 08.12.014 oblique 2014-15 dated July 15, 2014 on issue of long-term bonds by banks, financing of infrastructure and affordable housing, and related circulars on the subject. Housing finance, fair lending practices. It has been observed that banks follow divergent practices in release of movable or immovable property documents, leading to customer grievances and disputes. In this regard, banks should follow the guidelines issued by Circular DOR MCS REC 38/01.01.001 2023 2024 dated September 13, 2023 on responsible lending conduct, release of movable or immovable property documents, on repayment or settlement of personal loans. To ensure reasonableness and transparency in disclosure of penal interest, banks should follow the guidelines issued by Circular DOR.MCS.REC.28/01.01.001 2023-24 dated August 18, 2023 on fair lending practice, penal charges in loan accounts. Banks should follow the guidelines on Fair Practices Code for lenders as indicated in para 2.5 of Master Circular Loans and Advances and statutory and other restrictions dated July 01 2015 as amended from time to time. Housing finance additional guidelines. It is advised that banks should adhere to the National Building Code (NBC) formulated by the Bureau of Indian Standards (BIS) in view of the importance of safety of buildings, especially against natural disasters. Banks may consider this aspect for incorporation in their loan policies. Banks should also adopt the National Disaster Management Authority (NDMA) guidelines and suitably incorporate them as part of their loan policies, procedures, and documentations. Thank you very much for your presence.